Capital Discussions Roundtable. I'm Tom Nunemaker with our guest Ricardo, who's one of our experts today. Before we get started, a quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that, welcome, Ricardo. I see we have a few people also in Europe, so I think they appreciate the little bit earlier time.
How do you know that? How do you know they're from Europe?
Oh, I just recognize a few of the people in the room that
are
from, like Michael,
right.
I think. The UK, I think David's.
Okay.
Yeah.
I thought maybe Tom's got another special application there that I haven't got, that he can see that they're from Europe.
it's just a computer I walk around with inside of my head.
No, I thought Tom always has these magical widgets and things, so I thought he's got something else up his sleeve here. All right. Okay. Well, that's good to know.
There we go. David's in Norway. We got a good friend in Oslo. I'm not sure how far from Oslo you are.
David in Norway. Well, quite a few kilometers, but not as far as the States.
Yeah.
That's good. All right, Oslo. Okay. All right. That's good to know. Thank you.
So again, welcome back, Ricardo. I think your trades are doing pretty well in your service, but it'll be good to see what you have to say about the trades you've been doing tonight, and just a recap.
Yeah, we just started a new one about 2 hours ago, actually. Also, Tom, am I sharing my screen? Can you see my screen or what?
Not yet. Did you click share your screen?
No, hang on. Okay, there we go. Sharing screen monitor 2.
Yep, it's loading.
All right. Okay. There we go.
There it is. Okay, we see it.
Great. Okay. Thanks then, Tom. Good evening, good afternoon to everyone. Those of you in Europe, more or less good evening. Those in the States, more like good afternoon. It's great to be back. I was looking forward to doing this today because the service is doing really, really well. I asked Tom before doing this if I could actually say that out of all the alert services at Capital Discussions, we are the number one. I did ask him, I said, in percentage terms, can I say this, Tom, that we are number one? He said, yeah, because you can say it. So I'm going to say it. Percentage-wise,
you're leading the pack.
I'm leading the pack. So that's good. I'm happy about that. This is one of the reasons why we're doing the presentation today. And another reason is we're coming into the earnings season now in a few days, weeks' time. And one of the 3 alert systems that we do is on earnings plays, which is quite a fun sort of strategy that we do more or less once a week when we are more or less in season. We've been about 2 or 3 weeks now without a trade there because we're completely out of the season. But as I said, we've got the July month now coming up, and end of June, sort of July earnings season coming into play to do those plays, and that was sort of another reason for doing the presentation today. So, for those of you that don't know me, my name is Ricardo. I'm actually based in Spain, in Madrid. I'm English, or half English, half Spanish. I was brought up in London. But I've been the last sort of 24 years living here in Spain, where we do have much better weather than in England. I've been a professional trader now for quite a while. I manage my own money, and I also manage funds of others as well. I'm a teacher and mentor. I manage the Spanish division of Option Elements, where Tony Sizemore sort of leads the English division of Option Elements. I'm an author as well. Lately I've sort of published my first ebook, which was good. The thing is, that's in Spanish, not in English, so not much good for you guys unless you do speak Spanish. Quite honestly, I'm completely sort of bilingual, bicultural. I do a lot of translating and interpreting as well, specializing in financial and trading language. And I am also the representative for OptionView, the #1 software in the world for options trading in Europe, South America, and now also one of the representatives in the States. So that said, I've lost the chat. So if there are any sort of questions, do ask questions as we go. I'll answer them as
yeah, no questions yet.
Sorry?
No questions yet.
Yeah, okay. Right, so let's get on with the presentation. So basically, and I don't want to go on sort of too much on the sort of the technical aspects of our systems. Quite honestly, they're there for better and improved timing of entrances on 3 tried and tested strategies that, you know, have been working really well for a long, long time. So basically here in the introduction, the text that I've put down is what you're seeing, combining one unique tool, a trader's experience of years in the market, with the power and potential of quantitative, algorithmic, low latency systems, which you'll see now that we have actually developed ourselves in Option Elements Spain. We've been developing option-based strategies on market patterns that keep repeating themselves time after time after time. Strategies that have been tried and tested through backtesting and other types of stringent analysis. Strategies and systems here have been coupled together and developed as one to exploit the diverse correlation that exists between each of them for improved entrances and exits and greater risk control. Basically, what we're getting at here, what we've developed here in Spain in our algorithmic systems, and you're going to see now what sort of market indicators we use to enhance this, to achieve this, is to get better, improved, sort of just the timing of the trades, to get into the trade and to get out of the trade. And for the third alert, which since we started in March, we haven't had an entrance yet, because it is a sort of it's a medium-term sort of strategy that only sort of happens 3 or 4 times a year. It's a volatility sort of play. There we do adjustments for the trade, and here sort of greater risk control also comes in on the timing of those adjustments. The other 2 alerts, really, there are no adjustments. They're just in and out. Another thing I'm going to be talking to you guys about also today, the sort of the quick in and out emphasis that there is on these type of very, very, very short-term strategies, are very short sort of term exposure to the market, and often that's great. You know, that's great. It's sometimes hard to be sort of the whole month or 3 weeks or 2 weeks in the same trade, hooked on the market, waking up every morning just seeing what the futures are doing, or even, I don't know, sort of, you know, you're in bed at night, you go to the toilet, and suddenly, you know, you look at your what the futures are doing overnight and things, just to see if your trade's working out, things like that. These are very short-term trades. We're talking about just a weekend or just a night for the earnings plays, and basically, you know, one appreciates that. One appreciates the fact that we don't have so much exposure to the market, and we're not sort of hooked on the market, you know, for days or weeks on end. So here the system, or the systems of our unique alert service that really is doing very, very well. And as I said before, it is sort of the leader of the pack at the moment of the alert systems at Capital Discussions. We've got correlated patterns in the market that match a number of certain market indicators. Now, these patterns are the earnings plays, which I'll be talking to you about now, and I'll go into a bit of detail and some examples. The weekend option strategy in Russell, which a lot of people know about, but again, it's been doing very well lately. It actually would have lost 2 weeks ago, but we did not get a trigger from our systems to get into the trade for that week. So we actually avoided that week of being a loser. And this is where our systems really come into play and improve an awful lot and enhance sort of the track record and the profits of these trades. And the volatility mean revert system, which, as I said before, we actually haven't had a trigger to get into this trade yet, because volatility has actually been very, very low. But I must say, when we do get a trigger to get into this trade, this is a very, 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 very obviously there's no holy grail in trading, but we've up until now, when we've been trading this at, or when I've been trading this myself personally, I have up until now, touch wood, I've actually never had a loss on this trade. The thing is, you need a lot of patience, and we're talking about just sort of 3 or 4 entrances in a year. So I know this is a bit frustrating, the fact that you have to be sort of waiting a long time. It seems often that, you know, time doesn't pass to get the entrance on this sort of trade, but it's well worth waiting for, and it's well worth being patient. And basically the indicators, these certain market indicators that we are matching with these correlated patterns in the market for better timed entrances are accumulation distribution, ATR, average true range, fractal component price, which I myself, I mean, I'm not one of the engineers, I'm not one of the technicians that has actually created the system, I must admit that. But, you know, I did, before the presentation, get a definition on fractal component price, and I'll quickly give it to you. It considers price movement as totally random, except for certain moments when one can find a repetitive order. For those that are interested in knowing what fractal component price is. Implied volatility 10, the last 10 sessions, 30 and 90 sessions or periods, and open interest. So what we've been doing, and what we have been doing for a long time before we started up this alert service, is the experts add option elements. I'm not included in this as part of. I'm just a trader. I'm not part of the engineers or the technicians. Add option elements started developing sets of algorithms capable of replicating and following the detected patterns for better timed entrances. And as I said before, this is the key: better timed entrances. Better time entrances. Trading in the end is all about timing. It's all about timing, and here we're trying to get timing as best possible. Option elements is designed. We've designed our own proprietary algorithmic system and in-house transaction optimizer, primarily based on the QuantStart software and our own risk management and execution engine. The ultimate objective has been to detect better time triggers for certain high probability simple option strategies that can, and this is very important, that can be easily followed by traders and beginners and traders of advanced levels. The trades are very simple. It's a tiny bit more complex, the volatility trade, but the other trades are very, very simple. The earnings trades were either buying or selling options, buying or selling straddles and strangles. And the Russell trade of the weekend is a very, very repetitive trade. The only thing that varies is the actual time of entrance and time of exit, or the fact that we don't even do the trade for the weekend because we didn't get a trigger on the on getting in. So let's quickly take a look at the 3 strategies in question, bearing in mind we have the next earnings season about to begin. Okay, this is what I said before. Also, coming into earnings season. So the first year golden earnings plays, one-night trades, as I said before, one-night trades on certain stocks when presenting earnings results. The companies in the States, they either present their results just before the market opens or just after the market closes. Whichever one it is, we've got to put on the trade the night before and take the trade off the day after. Price, volume, open interest, and implied volatility are also taken into account to get the better in, first of all, to actually tell us that the trade is worthwhile doing, because the base of all this comes from a tool we've got in OptionView, a highly specialized tool that they've developed themselves for earnings play. They've got 5 strategies. I'll go through the 5 strategies now. But what we've done is we've taken these strategies and we've actually back tested them all on the different underlines that are used to do to base the strategies on, even further back in time. And like this, we can be more certain of sort of trades turning out to be profitable or not. So I'll go into this a bit later on in the presentation when I go into detail on the earnings play. Basically, the strategies that are based on the earnings plays are medium and high volume US stock options, and we look for both lateral and directional movements. Usually when they're lateral, we're selling options, and when they're directional, we are buying options, either straddles or strangles, sort of 90-95% of the time. As I said before, we've got several years here of back testing. Now, the 5 strategies I've got listed here under A, B, C, D, E. First of all, we have movers, trades on stocks that in general make a bigger than expected move. Even though implied volatility is high, it still usually pays off to buy the straddle or strangle, to be buying options. Most of you, I would have thought, know that as we get closer to the day of releasing the results of the company, implied volatility tends to go up. This is because we are approaching a day of uncertainty, of not knowing exactly what the results are going to be. And when this happens in options, the implied volatility goes up. And these stocks, even if the implied volatility goes up and the price of options go up, they become more expensive, it is still worth buying those expensive options, because usually the move that underline that company makes in the price of its shares is pays off even though the implied volatility is that high. Then we've got B, non-movers, which is completely the opposite. Here we have trades on stocks that in general make a less than expected move. Even though big moves can be made, it usually pays off to and is more profitable to sell the options, either sell the straddle or sell the strangle, even and sell those expensive prices and those high levels of implied volatility. Then we've got the third strategy, pairs. These are trades on stocks who tend to make big moves when their competition releases results. So here you may have Coca-Cola and Pepsi-Cola, for example, or MasterCard and Visa. Because they themselves are not announcing earnings, implied volatility remains low. So let's say that Coca-Cola is announcing and Pepsi-Cola is not announcing. So the implied volatility of Pepsi is still really hasn't gone up because they're not announcing. But usually the effect of whatever sort of move that's made in Coca-Cola as they're announcing their earnings makes a bigger influence effect on the share prices of Pepsi. However, they often jump with the stock who's announcing. So say, I don't know, Coca-Cola announces, it's up 3% the next day or whatever, or maybe Pepsi-Cola's up sort of 1% or something also, just because Coca-Cola's gone up and their implied volatility is still low because they themselves are not announcing earnings. Echoes. This is a bit more, tiny bit more complex. If we do have time, I'll show you an example of these. Here it involves two stocks from the same industry. If the first stock announces and moves more than 3%, either up or down, and within 18 days of the second stock announcing, usually stock two will make a similar directional move. So again, with Coca-Cola, well, let's say MasterCard and Visa. Say MasterCard announces their results, they're down 4%, and 10 days later, Visa's going to be announcing their earnings. Well, what we do is we're not going to do anything with with MasterCard's release. But 10 days later with Visa, what we're going to do is some sort of a bearish play on Visa for their announcement, as the name of the strategy implies, echoes. It usually has a sort of a similar type of move to what their competition had a few days, at least 18 days or less before. The last one, runners, these are stocks that tend to make more. Sorry, these are stocks that tend to make the move within market hours. Generally, they will go up. They'll go either up or down and continue to prolongate that in that direction for the rest of the day. Here we either go long or short as the market opens. So basically here there's no trade overnight. What's happening is that the stock makes its announcement is next day 3:30 our time here in Europe, Central European time, or 9:30 in Eastern time in the States. The market opens, it jumps up 2%. So what we do is, if it's up 2%, we just buy on the market open the stock, or not buy the stock, but I mean put on some sort of option strategy which is bullish. And usually what happens here is that it continues to move upwards as the day goes on, and we take it off. We take the strategy off at the end of the day. Now here, the Russell trade. This is most probably the trade that we've been most doing in the last few weeks. We've actually got into this trade today. It's also up. It's also up. I've got it here on. This is the trade that we put on about 2 hours ago, and the alerts went out. About $92 more or less already on this. There we go. So here we're using strangles and iron condors. Basically, those with a margin portfolio account can do strangles. Those with Reg T accounts can do iron condors. The alerts actually go out for iron condors for the smaller accounts, and this is done on a weekly basis when we do get the trigger to go in. As I said, we didn't actually go in 3 weeks ago, and we missed the losing week. And here, basically, what we're doing is we're using weekly and short options, exploiting a tried and tested strategy plan that has been tried and tested for many, many years now, and is doing really, really well. Basically, we're exploiting. Depends how much you really know about options trading, but there is a lot of decline in premium on sort of Thursdays and Fridays because of the approach of the weekend. And basically what we're doing is we're using the Russell 2000 index options to actually sell them and benefit from this decline in premium. Again, more effectively timed entrances and avoidance of bad trades are achieved through the fractal component price, open interest, and average true range. These three indicators are the ones that are used in our system to get the best entrance and exits for these trades. And then the third, the volatility edge. As I said, since March, we haven't actually had a trigger to go in. Implied volatility needs to go, at the moment, implied volatility needs to, more or less, we'll get a trigger when, based on the VXN and the NASDAQ. So here, the VXN is the, for those that don't know what the VXN is, it's the index of implied volatility of the NDX. And quite honestly, to get a trigger here, more or less, like, I mean, I can tell you when, more or less, we're going to sort of, our systems will tell us to get in. It needs to get up just a bit above this resistance we got here on the VXN. This is when we're going to get a trigger to go in. Last year, there were about four entrances, here, 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 and here. So there were four, okay? Four. We implement short and medium-term high-probability income trading strategies on the NASDAQ 100. The general environment for entrant triggers are those of higher implied volatility levels. So I want to say something here. Many people have asked me because, you know, at the moment on the alert service since March, we're actually up 20%. We're actually up 20%. This is why we're leading. We're up 20% on an account of $25,000. What surprises people is that our trades are very, very small. You know, out of the capital we got at 25,000, we're actually using very small amounts, percentage-wise, of our capital, and this is because we need to have available quite a bit of capital there to get into this volatility trade when it does come up, because when it does come up, as I say, the odds are very, very high in being profitable. As I said, I myself, I've never actually had a losing trade, but I mean, obviously there is no holy grail, as I said before, and there will be a losing trade one day, but up until now, there's been no losing trade on this one. The only thing is we do need a bit more capital than what we're using for the Russell, for the weekend trades on the Russell 2000 and the earnings plays. The general environment for entrance figures are those of higher implied volatility levels, as I've mentioned before. And here the market indicators that we're using are in our systems for the trigger of going in and out of the trade. And here there may be an adjustment as well. Here there may be an adjustment. Same thing. The timing of the adjustment is all down to our system, and the system basically is made up of fluctuations in implied volatility levels of the NASDAQ 100, levels of accumulation, distribution, and personalized volatility indicators that we've actually created ourselves. Now, before going on to any examples, this is a live historical, or the live historical results at Capital Discussions. Live, I mean, well, at this very moment, actually not at this very, very moment, because at this very, very moment, there is a new trade on, which I just showed you, which is up about $90 or $100 already, which, you know, if we wanted to, but basically it's all based on a $25,000 account. We're up 4,888, basically nearly 20% since March, since the 12th of March, okay? 12th of March to the more or less we're in the middle of June, so that's 3 months, 20% up in 3 months. I want to get in the benefits of the service before we go on to examples, just in case we do run out of time. As I said before, short-term market exposure, quick in and quick out, and that's great. You know, that's great. We can still got a lot of free time. We don't have to be tied to the market day after day after day after week after week after week. We've got a choice of strategies here that are all very profitable. They're all working out really well. Depends on how frequent you really want to be in the market. Or you could just do this, the volatility trade, which is getting into the market 3 or 4 times a year. One of the keys to trading is patience. I said before, timing, and to get your timing right, you got to be patient. Got to be patient. More flexibility in being in or out of the market. You know, it's up to you. Maybe you've got a lot of work on at a certain time of the year, so you don't want to be in the market so much, or maybe you've got less work on and you can be in the market so much, or maybe you want to go on holiday and you don't want to be in the market at all. You know, so their flexibility is pretty important. A simple plays, no complex trades. I mean, the only one that's sort of may have an adjustment is the volatility trade. But as I said before, the Russell trade is basically just an iron condor or strangled, and the earnings plays are just buying or selling of straddles or strangles. We do all the work. You don't have to think about what we're doing or why or the time of entrance or the time of exit or whatever. We do all the work. You just sit back and execute those trades. And they really are all tried and tested, and you know, especially the earnings plays. They're fun strategies. They're fun strategies. So examples. Actually, before going on to the examples, I'm going to quickly just say what's included in the service, the price, and get all of that out of the way. And because I've got lots of examples, I mean, with the examples that I've got, we go way over the time. So at least if we can get that out of the way, and then I don't have to be too concerned with the rest of the presentation, getting it out of the way. At least, including the service, at least 8 option trade alerts per month, usually quite a bit more. Video recaps of results and performance of each strategy. We do that once a week. As I said, I mean, in the last 2 or 3 weeks, it's really just been the Russell strategy. There's been nothing else. But we are coming into the earnings season now. Real-time trade signals, courtesy of capital discussions for entrance and exit for each trade. The alerts are sent out via SMS and email. The signals are frequent as they are short-term in and out trades. And I must say, really, the service that Tom and Jim are providing through capital discussions for these alert services is next to none. It's just brilliant. It's brilliant. You know, everything is catered for us experts, giving the service, for you guys there, receiving the service. Any complaints at all, and there really haven't been any, but any complaints at all that have come from customers about the service, you know, it's been, you know, immediately sort of corrected. There's everything there. It's just a brilliant service that they've got. It's very efficient. It's very easy. And I must say, you know, Tom and Jim, Capital Discussions, they're really doing a great job in providing this service. They really are. Makes our life. Sorry.
Thanks, Ricardo. I appreciate that.
No, yeah, it's the truth. It's the truth.
Well, just to be clear, the services aren't trade recommendations. The subscribers still have to make the ultimate decision whether or not to take the trade.
Of course.
These are just what you're doing, and they can learn from them.
Of course. And the service that the Capital Discussions are providing, I mean, I'm talking basically about the mechanics more than anything, Tom, not about the actual recommendations. Right? I mean, the mechanics that you guys have provided, both for the final customer and for us guys giving the service or giving giving out the trades that we're doing, is really next to none. You know, I've actually researched this a bit, and I've been looking at other services online and things, and there's nothing like what you guys have got here. It really is good. So say that. And access to all trade messages, recordings, documents, and images. And I think just last of all is what's included. To continue what's included. So a monthly real-time track record follow-up of the strategies, which you've all just seen now, as I brought it up on the presentation. Anything that comes to me, any emails, phone calls, or whatever, I attend them really as soon as possible. I really do, and you know, I do sometimes make mistakes. I try not to make any mistakes, but from once in a while I do make mistakes. A lad wrote to me today saying that there were apparently 2 images on the trade. I don't know why there were 2 images, but you know, I am human. I can make mistakes sometimes in the service I'm trying to provide here. But please, you know, I really do try and get back to people as quick as possible on any questions or doubts. Private forum exclusive to the service. We're still setting that up. That's actually not set up 100% at the moment, but it will be soon. And I mean, the best thing, you know, a no-risk 15-day trial. Please, why don't you try the trial? I did ask Tom if we could put the link in the chat for people to try out the trial. I mean, just try it for 15 days and see if if it's for you, if you like it, if it really is sort of what I'm going on about here in this presentation, etc., etc. So try the trial, no cost. And the price, well, you got the 15-day trial, which is free. Per month, it's $119. I mean, quite honestly, with what we're achieving here with this alert service, I would have thought $119 a month, is easily covered. If you're paying per quarter, is a big discount of 16% when it goes down to $300, and the discount for 6 months is 23%. So as it says there in the bottom, that little phrase, the cost of the service should easily be covered each month with such profitable short-term and frequent strategies. So, Basker, no sound. Is everyone else? Tom, is my sound all right? Or something happened to the sound?
Yeah, sound is fine. I just typed in there for him to rejoin the audio broadcast, and I did put the link to the sales page that has all the information and the order links. But do you have time to show maybe an option view, one or two of the trades that you've done in the?
I mean, you've all just seen basically the trade. I mean, for the second alert, this is a trade we got into sort of 2 hours ago, which I said is sort of up $90 already, and we'll be getting out of this trade either Monday or Tuesday of next week, whenever our systems tell us to do that. So I've got a few examples here. Amazon is a big one that we do when it comes up for earnings. So what I can do is get into BackTrader. We'll go to the last Amazon. Where's Amazon here? Here. Last Amazon release of results. Which was on the 23rd of April. So I'll try and do this as quick as possible, because there are quite a few examples. If there are any questions, just please let me know what they are. So this is the 21st. Let's go back to, so I've got my option view obviously on European time. This is 9 o'clock. This is an hour before the market close. So we go to Thursday the 23rd. And down here on my option view, I've got, you'll see five different pages: E-primes, E-overs, E-pairs, echoes, and runners. These are the 5 strategies that I quickly went over now in the presentation. And so we're going back to the 23rd of April, the last time that Amazon gave released results. You'll find also, so this is sort of the base of this alert system is actually what's offered here by option. The thing is, we've actually gone way further into it all and developed it all a bit more. But there's a weekly planner, okay, and here it's telling us that Thursday, 23rd of April, there are a few different strategies to pick from. Again, it's our systems that tell us which of the trades are sort of the soundest, the best to get into, and they'll also give us the timing on getting into those as well. But here we got at Amazon, prime mover, quality 36. When it says quality 36, it means that on the last X amount of times that it's released results, the total profits that all the trades have given, losers and winners, is plus 36. Okay, plus 36. That includes the losing trades as well. DVO is just the volume of that underline of Amazon. So here we go to Amazon. as that weekly planner said, we're on the 23rd of April, and they are releasing AMC after market close. BMO is before market open, AMC is after market close. If I right click on this this tab here, basically it's telling us what option view would do, buy a straddle or a strangle about an hour prior to close, and on the 23rd, which is right now, close the position anytime the following day. The timing of the close of the following day again is based on our system. So I think that day we actually got the trigger to go in at about 9:30. At night, which is 3:30 in the States, Eastern time. We'll see the price chart and the volatility chart. You see, it can make big moves like this. I mean, not always, but it can make big moves like this. Here, volatility goes sky high, so the options are expensive, but it's still telling us that it's worth buying these options. Again, the trades are small. We really never do more than 1 or 2 contracts for each play, and usually, I mean, sort of 90% of the time, the options that we're buying are if there are weeklies, the weekly options. If there are no weeklies, well, it's the front month of the monthly options, the closest that there are available in expiry. So basically, buying this straddle, just one contract, but Amazon's an expensive underlying, so you know, we're still pretty leveraged just with the purchase of one contract. We convert that, and I think, well, let's go on. I mean, I think but I didn't research this enough before the presentation. I think we went on to the end of the day on this one. Anyway, the next day was up $53, sort of percentage-wise, I don't know, near 60%. I think this one we really did take sort of to the end of the day, and we earned even more, $2,524. So this is just an example, okay? This is just an example of how the movers work. Often, I don't actually include, it depends on how leveraged the trade is, all right? Because the thing is here that usually the trades that we're doing, what I try and do with these earnings play trades is get them all sort of into proportion. But it's a bit difficult to do sometimes because, you know, sometimes we do get a play that comes up which is as expensive as Amazon, and the thing is that just on this one contract, you know, we can actually earn an awful lot of money or lose an awful lot of money. And, you know, it's great when we make an awful lot of money, but just say, for example, we lost, we lost money on this trade. You know, if it's too big and it's not proportionate to the other trades that we've been doing on earnings, it'll distort quite a bit our track record on the earnings plays. So I must say that these examples that I'm using here, not necessarily they've been used live on the alert service. I must say that before I go on. I think it's only fair to say that. What I'm trying to do here is just give an example of each of the five strategies. Now I've got another one here. So let's take this off. Another one here for non-movers. What's the time? 10. Okay, we've got an hour, so we've got about another 10 minutes. Go on to the 28th. And again, as I said before, the problem with the also with the earnings alerts is that, you know, there are a lot at the time of the earnings season, and when we get out of the earnings season, there are less. So again, here, TWX, TW Telecom. Okay, this is a non-mover. Here, basically, what we'll be doing is selling a straddle or selling a strangle. This has got great results. Usually earns 50%. That this includes the losers. 7,8 means out of the last 8 times the company has released results, this strategy of selling options has actually turned out to be a winner. Just once it's lost. But what we've done with our own systems is we've gone back in time much more than the last 8 earnings releases. 8 earnings releases is just 2 years. It's 4 a year, so it's 2 years. I mean, for some of the earnings plays, we've gone back, you know, 6 years, 7 years. Okay, because we've got that historical data in OptionView. OptionView's actually got 13, 14, 15 years of historical data that we can use. So basically, this is a non-mover. This would be a non-mover, TWX. What we'd be doing here is, again, 9:30. Here we'd be doing the reverse to what we've just done on Amazon. Sell a straddle. And as you can see, the price of TWX is $85, where Amazon was at sort of 360. So this is a good example of what I've been trying to say before. We try and keep this as proportionate as possible, which is sometimes a bit difficult. This is just one contract, and here, as you can see on what we earn and what we lose, it's quite a bit different, the amounts to what we're earning and losing on Amazon. Okay, it's another reason why the actual examples that I'm using here not necessarily have been done live on the alert service. So we started off like this, and basically let's just go to the next day, 3:30. See here that applied volatility, as I said before, has gone high, it's plummeted as they give their results. Again, this one turns out a winner. The amounts, as I said, you know, nothing like what we just saw in Amazon. This would be more similar to the sort of trades we're doing on the alert service. Okay, maybe here we could sort of sell 2 contracts instead of 1. But these are sort of the amounts of money that we're talking about on our alert service. Of course, anyone that's following the alert service can, you know, multiply the contracts that we do on each strategy by however much they want. It all depends how much money they've got in their account. But as I said before, the trades that we're doing on the Russell 2000 at the weekend and on the earnings plays are small. We're up 20% since March on, you know, on these small trades, because we need the money available there for the volatility trade if that does come into play. Okay, so again, well, this was a winner. I don't know. I mean, take it to the end of the day. I don't know exactly when. Our system would have said that we got out. It actually earns more at the end of the day again. We'll take this off. Now then, quickly, time for a pair. This one we did do. I remember this one. Pairs. So let's go on to the 23rd. This would be a typical trade. 23rd, we got the trigger to go in at about 7:30. Pairs, and this particular pair involves Delta Airlines and Delta Airlines down here, and Hawaiian Hold, both competition. And what's happening here is We're on the 23rd, right? So Hawaiian Hold is releasing results after market close in a few hours' time, and basically what we'll be doing is buying a straddle or a strangle in Delta Airlines near the close of today, 23rd of April, and close of business any time the following day, although historically it's been profitable to hold the trade until the end of the day. So what's happening here is that, let's have a look at the implied volatility of Hawaiian Hold. It's been going up as we get closer to the day of earnings. And Delta Airlines, they've already released their results a few days before. So basically what's happened here, this is pretty good, okay? This is good because they also had their jump in implied volatility. They released results and the implied volatility has plummeted. So quite honestly here, the options are very, very cheap. It makes sense to buy a straddle or a strangle in Delta Airlines, okay? So what we did was another important thing that I haven't mentioned. We do take into account slippage in the alerts as well, okay? For those Russell trades at the weekend, we do take into account slippage, and we do take into account slippage for these earnings plays and for the volatility trade. So here we go. This is here because we actually did it. Slippage taken into account was sort of down $13. Commissions of $4. And this is the trade we have. And if I remember right, I think we got out of this at sort of 5 o'clock the next day. So what I'll do is just go forward. So Hawaiian Hold releases their earnings. Let's see what happens to Delta Airlines. Delta Airlines jumps. Exactly what happened to Hawaiian Holding, and Hawaiian Holding was up 11.5%, and the effect on Delta Airlines was that it went up nearly 2%. Okay, that's sort of the idea. Now we're on Hawaiian Hold. Timothy, good afternoon to you as well. Okay, so this is an example. We did do this one. Okay. What you'll find with these earnings plays is that there can be a lot of losers. Okay, there can be a lot of losers, maybe 50% are losers. But usually, what happens is that the losses are very small and the winners are huge. Okay, that's why it makes it such a profitable alert service. The thing is with that, you do have to. Because maybe you've got sort of 50% winners, 50% losers, you do actually have to take all of the trades so as the probabilities do work out over time. All right. But there are quite a few losers, but usually the losses are very, very small, and the winners are huge. Okay. So Tom, I don't know. I mean, it's I've been on now for about an hour.
And any questions for Ricardo before we wrap it up? I don't see any in the chat.
No, nor do I. Is it all that clear? And concise.
Really like
again.
Of the earnings of the pair, that's a great idea. I think Len came up with that, didn't he?
Yeah, the main idea came from Len at OptionView, and it's one of the ones where I think it's the strategy that we've most researched and most analyzed and gone into. It's a great one because the fact that the competition, because the one that's the stock that's not giving earnings, the implied volatility is still low, and it's even better that they've a few days before that they've released their earnings, because then you've got a huge plummet in implied volatility. Sometimes it's not as good because maybe a week or 2 weeks later they themselves are releasing the earnings, and already implied volatility is going up a bit. So there could be a bit of increased implied volatility there. But if the pair has already released their earnings, like the one we've just seen now, it really is a brilliant play. And that sort of play, that sort of strategy comes up a lot. Our systems give it a lot, and it works out really well, really well. Marta, just curious, what broker do you use over in Spain or no, Interactive Brokers. All of this is done on Interactive Brokers. Interactive Brokers, yeah. And basically, well, that's it. I don't know if you want to add anything yourself, Tom, or...
Well, yeah, I mean, we don't need to keep anybody if we're done. It looks like we're at an hour anyway, so this is probably a good place to stop. So, Ricardo, thanks very much for sharing how your service is doing, walking through some of the trades. It was pretty interesting. And keep up the good work.
Okay, I will do, and you guys as well. Thank you again. Thank you to everyone that's attended the session today. Please, try out the trial. Try out the trial. It's no cost, and nothing to lose.
And if you can email us at support@capitaldiscussions.com. We'd be happy to answer your questions. So thanks again, everyone, Ricardo, and we will see you next time.
Okay, great. Thanks a lot, Tom. Thank you, everyone else. Thank you. Good evening, good night, good afternoon. Thank you. Bye.